Hi folks, Michael here. Some people invest in real estate, but few investors make substantial profits, largely due to not knowing how to make profit. It's not all about buying and holding, waiting for market appreciation, or flipping and reselling the property for a quick buck like you see on HGTV. In this video, I'll concentrate on residential real estate, so where people live, with some core methods of making incredible profit. And the benefit is that this profit is mostly tax-free. I mean, who doesn't want that, right? So I'll share with you the overall approach, 4 specific core strategies, and finally how to extract the value you just created as an intelligent, educated investor. I'm excited, so I hope you are too. So the key thing here is to sort of buy under value and reappraise. So how do we do this? Well, we can buy, first of all, above the flipper price. All right, those people you see on HGTV, they want to buy a property and then flip it maybe in 90 days, because usually they have these 90-day or 3-month notes and they have a very high cost of capital. So you can buy a little bit more expensive than them because they need to pay off the capital, the loan essentially in a different regard, a much higher rate. So you can pay a little bit above their price, but under retail price. And what I mean by that is what a turnkey or a move-in ready property would sell for. What your typical Gen X, Millennial, Gen Z, if they're moving into a property, or mom and dad kind of moving in, they want everything right just now. They don't want to wait. So that's your really retail. So somewhere in between. The equity that you have in the property usually jumps when you ask your mortgage company to reappraise the property after you add value, which we're going to get into, or sell. Now, if you're selling, you want to consider something like the 1031 exchange that you can set up in certain situations where you can defer the tax so that you don't pay it right now. You say, hold on a second, I'm going to take a break. Let me pay it in the future. And you can do this again and again and again until you die, and then it's too late to pay the tax, right? So you could do the 1031 exchange every time if you set it up correctly. You can also, of course, extract value from the property. So that's where your equity is really jumping. So let's get into the core of the strategy. So the first is condition. This is my favorite. So this is what they typically call a fixer-upper. So it's a property that needs some TLC, it needs some work or attention. It could be that it hasn't been renovated in quite some time. It could be that it's got very bad interior cosmetics. It could be the painting needs to be redone. It could be that the flooring needs to be redone. It could be that the countertops are a little bit icky, things like that. Smell, condition like that. So this is usually a really good value, especially if you're looking at a single family home, where the single family home, the difference in the price there is massive between a house that is move-in ready and looks really nice versus a house that is going to need a lot of improvement before someone's going to be happy with the home. Now, the biggest bang for your buck is typically on paint. So that usually, if you invest in painting a property that's a fixer-upper, you get the biggest return. But then after painting, you get things like the flooring. Maybe it needs to be resanded. Maybe the carpet has gone moldy. You need a new carpet. It's very cheap for recarpeting. It's very cheap for sanding. Then where it starts to get more expensive are things like vinyl, luxury laminate, tiling, things like that, marble, of course. And then you're moving above what's necessary for a rental at that point. And, you know, that's when you start to lose out. It's no longer really an investment. It's more of a consumption activity. You're doing it for yourself. A lot of landlords over-improve. Renters are less concerned about that. Renters don't really care about, what kind of rock is the tile. They don't really care what the Italian rock you're using is in the kitchen. You could just have your basic granite. It doesn't need to be marble. And by the way, if it is marble, even quartz, it's going to require more care. Now, you can, of course, prep it or coat it, but it's still, the more you put in, the more expensive it is. You're going to spend a lot of money, and if you were to look at revaluing the property, you're not going to get the same jump in equity there because you've overspent on your investment. But condition, again, It could be that you need to do more significant things or smaller things. It could be that you need to do things like the hardware, so knobs, doorknobs, kitchen. It could be that you're redoing kitchens, redoing bathrooms. These are usually your best areas to be spending on. After that, though, the return on investment is a little bit lower after that. Like the exterior, there's much lower return on investment, but you may need to do certain things. Of course, if you've got to redo the roof, that's really a structural, or the windows, a structural. Air conditioning, it's not necessarily going to improve the price of the house, but it would actually help the house to sell faster if that's what your goal was. So these systems like electric, plumbing, of course, they need to be done. But the goal is to go into a house that just really needs cosmetics, that the structural work has been done and it's been kept up. It's just that it needs maybe a new coat of paint, new flooring, new tiling, countertops, things like that in the bathrooms or the kitchens. And maybe some new lighting, okay, like some new faucets and some new lighting. It could be that the lighting is very yellow, or it's old-fashioned or drab or something. It sort of was fine in the 1970s or 80s, maybe even the 90s, but it's really out of fashion at this point. So something that looks more modern is always very good. And of course, not going too much. You're not thinking about what you want, what you would like, not too special, but what the general public would like. And really just minimal, like not spending too much. You want to think about what is the cheapest thing and then go up one notch. So not the cheapest, but just up one notch. That's typically where your best investment spending is, because there is where you spend so little and yet the value jumps up so much that the difference between what you spend and what you actually are getting in return is usually the maximum. Usually go to the lowest improvement and add one level up above that. As you start to add levels, your costs go up, and the improvement in the actual value is not really that substantial. So you don't really see the profit going up, starts going down, in fact. So that's the first thing, that's condition. Now, another part of the strategy is if you find an over-improved property. It could be that the previous owner, they really went to town with wainscoting and there's lovely paneling, or they have put in ceiling speakers that they've left there. It could be like a surround sound system or 7.1 or 9.1 Dolby Digital, whatever it is. It's over-improved. If there's a jacuzzi, it's typically over-improved. If there's, a ballroom, things like that they've left in the property, bars, things like that. Typically speaking, what you're doing with that kind of a deal is you're going into a property where you are getting things at a discount, because the cost of you installing these things would be more than the difference in the house value were it to be sold without those things. So it could be the case that it might have cost the owner $100,000 to do all these improvements. But if it was, say, a $700,000 home, it's probably not going to sell for $800,000 with these improvements. So you've come in and you've bought it for maybe $750,000. So you've got the improvements at half price, essentially, if that's what you want to do. Now, I'm not really a terrible advocator of over-improved homes as a way of creating a lot of value, but if that's your thing, you want a much nicer home at a fraction of the cost, that's a good way of doing it. Another strategy you could look at is the rent. And here we're thinking about, for instance, especially with the 2-unit plus, so apartment, 2-unit, duplex, 3-unit, triplex, 4-unit, quadplex, they're called small multifamily as opposed to large multifamily, which is 5 units and above, usually because the actual mortgages are very different when you're going to the 5-unit and above, different qualification standards, etc. But usually when it's 2 units and above, the price of the value of the property is not necessarily the condition. It's a lot more to do with multipliers like the gross rent multiplier, or GRM, which is the price of the property divided by the annual gross rent. So if you can improve or increase the annual gross rent, you can increase the price. So one triplex property plus a commercial office in the garage outside that I almost bought at one point. I was very close to sealing the deal on that property, but I pulled out last minute. I noticed that the owner of the property had been charging pretty much the same rent through the goodness of their hearts for about 20 years. And the rent had not kept up with the market. Now, those renters were leaving and they wanted to sell the property, and yet the rent was still very, very low. So if you increase the rent, then the actual price of the property as it is evaluated should go up because of the gross rental multiplier being about the same in the area for comparable or comps. So again, if someone before you had kept the rent low relative to the market, and you can come in and you can increase the rent, maybe you do a few little cosmetic tricks as well to improve the value for the tenant, then the price should increase. So again, because the GRM or the gross rent multiplier is fairly constant in the area that you're looking at for the comparable or comps, properties that are comps. And finally, there's an extra, right? Thinking about what extra could you do with this property? Well, it could be that you go above and beyond the regular rent by looking at maybe converting it into a short-term rental and then really cash flowing the property. And that, of course, will add to your value. So potentially legalizing certain issues, and all of a sudden the property becomes viable on the market. It was massively undervalued when certain things were not brought up to code. The papers were never filed for certain add-ons like ADUs, additional dwelling units, things like that. So if you know your stuff, now I'm not advising you do this. I have done this in the past. I've done the short-term rental, I've done the legalizing, I've increased the rent, and I've also done the condition. I've improved the condition. I haven't really done so much of the over-improved stuff. I have improved the properties, but I haven't really been buying properties that were over-improved. But the other strategies, the C.O.R.E, I have. And again, this is just, more advanced tips, but I hope that this is really helping you guys see how you can make instant returns. Because again, you could buy a property that's massively undervalued. When you're going through the negotiation, it could turn out that when you're getting the property appraised, just to get the mortgage you're getting to come in, the actual appraisers could tell you that actually what you're paying is under the value. So, the property already has created, that happened to me in the past, where one of the properties I was buying at such a cheap price because there was legal issues, there was condition issues, there was low rent, etc. It wasn't value, it was multifamily. The appraised value of the property came in higher than the price I was buying the property at. So already I hadn't even bought the property and I was getting an extra few $1,000s worth of equity right there and then. And then once I improved these properties, all of my properties, the actual values of the properties have jumped up in certain cases by several $100,000s within a few months, just from legalizing or improving the condition of the property or increasing the rent by creating more value for the tenants. The new tenants were willing to pay more because obviously it was a new home. It wasn't something that was 50 years since its last renovation. It was no longer tired. So now it looked like it was a 2020s property. So these are just some strategies. Hope they help. Okay, so you've either identified a property that you can use the core strategy, one or more elements of, or you've already acquired it, or you've even actually implemented these strategies. So now how do you extract the value from the properties? So I've been looking forward to telling you guys this. I'm excited about this one. So the first thing you can do if you're thinking about selling the property is you could maybe 1031 exchange it. And as a result, you wouldn't be paying taxes on the increase in the value of the property. So if you're 1031 exchanging it, you just need to know that you have to identify another property that you can actually exchange. And usually it means you have to keep the money from the proceeds from the sale in escrow. So it can't even temporarily go to your account. So you should really check with licensed specialists for the exact details that could change from year to year, but really do come to them with these ideas, like how do I 1031 exchange it, etc. Now, another thing, of course, you can do, and this is part of the extra, is you can rent out short term, and that extra money coming in. One of my first properties, that's what it was. It was just like all of a sudden my income jumped precipitously, and as well as my equity, but the big jump initially was just suddenly getting low 5 figures monthly from rent alone from a short-term aspect of a property. So over about $10,000 extra a month from this one property that was renting short-term. And that's pretty quick as soon as it's renting. Another thing that I've done in the past as well is reappraising the actual properties. And then if I came in with the lower down payment, because it was originally a house I would live in, so I could get a low down payment, but I would have to take out the private mortgage insurance or PMI. Once I reappraised the property and showed, hey, look, I've done all this renovation. There's no way that the property only is worth this much. So if you please reevaluate the property and see that what I owe is now a much smaller fraction of what the property is worth, there's no way I should be paying PMI. So the mortgage company comes in and they send out appraisers, and the appraisers then look at the property and say, yeah, you're right, the actual property is worth a lot more now, so your equity is a much higher percentage. We will subtract the PMI, and right there, you're paying a lower monthly mortgage, right? You're paying a lower monthly because the PMI could be a certain percentage, it could be $70, $100, $150, but whatever it is, you're not paying the PMI every month. But also there's a boost to your net wealth, okay? Not your liquid net wealth, but if you're tracking your net wealth as the equity that you have in these investment properties, then you can see that, well, if the investment property went up by 100, 200, 300,000 with the reappraisal, that just spikes your net wealth right there once you got it reappraised. So for instance, in one property, it was like 506 and it came back at about 800. Right, so it was just almost $300,000 reappraised just like that. So that's a wonderful way to wake up in the morning when you get the email coming back in telling you that you've had your property reappraised and it's now worth much more. But how do you really tap in? Again, these areas you're not paying tax, you're not selling it, or you're deferring it with the 1031 exchange, or you're talking about the rent, which you do pay tax on the rental income, but you're not really paying tax on the reappraising. So how do you tap into that extra equity? Well, if you're living in a property and it's your residence, then it's something like the HELOC, the Home Equity Line of Credit, which is essentially like a credit card using the collateral of your house. You're taking out a line of credit against your house at a variable interest rate, typically speaking, over a certain number of months or number of years. So you don't have to take the money out, you're not borrowing it, but it's just there if in the future, for instance, you wanted to tap into it to borrow to renovate either that property or another property or do some other business. Or, I'm not suggesting going to Vegas, but whatever you want to do, you've got an extra source of credit at your disposal that maybe wasn't there in the first place. So for instance, if you put down 3% or 5% for a property, you renovated it, it reappraised, now you have 20, 25%. You can get some HELOCs in certain cases that are almost like 90% LTV. So you could have a 90% loan to value and the extra 10%. So maybe if they find that, well, you've got 25% equity, well, that means that there's a 15%, between 25% and 10%, you could take that 15% out of your house. That is a collateralized loan. So you don't take the money out, but you can in the future write checks up to that value, right, of the property. So that's a HELOC. An RLOC, when you're no longer living in the house, when it's now an investment property, it's a rental line of credit. Similar things apply. Typically, though, it's a much higher percentage, 20, 30% equity and above. So you're not able typically to take out the first 20 or 30%. So maybe when you own 40, 50% or above of the property, then you can think about tapping in to that differential between their minimum, 20 or 30, and what you have, 40 or 50. So that's maybe 10 to 30% that you can take out of the property. Or a business line of credit, but that's a little different, a BLOC. Getting a lot of locks here right now. So guys, I have been looking forward so much to making this video and creating it for you for some time now. And if you like this investing video, please don't forget to subscribe to my channel. It helps the algorithm and it would mean the world to me. So thank you so much.